Welcome to the deep dive. Today, we're embarking on a journey into a company that has quietly, yet profoundly, built an industrial fortress over, well, a century now. It's a business that really thrives by navigating some of the biggest global challenges of our time, like resource scarcity and, the ever-present need for hygiene. We're talking about Ecolab Inc., ticker symbol ECL, a company that's positioned itself as pretty much an indispensable partner for businesses all around the world. Our deep dive today, it's going to reveal, I think, a truly exceptional, high-quality enterprise, formidable competitive advantages, a bright long-term future. But we'll also tackle a crucial question. Is its stock currently trading at a price that fully reflects or maybe even slightly exceeds its fair value? For the long-term value investor, this might mean, well, a wonderful company without a significant margin of safety at this specific moment.
What's truly fascinating about Ecolab, I think, is how it has woven itself into the sort of the fabric of modern industry. It makes its services absolutely essential. So our mission today is to uncover the intricate layers of its business, from operations to financials, really understand its intrinsic value and potential risks. We've brought together a comprehensive analysis, research, market data as of August 23rd, 2025, and various financial reports to guide us through this, well, complex landscape.
All right, let's unpack what makes Ecolab tick then. Explore its powerful compounding moat and see what all of this means for you. We're going to begin with Chapter 1, Business Analysis. Okay, so at its core, Ecolab is a global leader in sustainability, offering these integrated solutions for water management, hygiene, infection prevention. They operate with a pretty unique approach, often branded as One Ecolab, building on this legacy of what they call Circle the Customer, Circle the Globe.
That model is absolutely central to their success, really. When they say circle the customer, it means they aim to provide like a full suite of solutions to a single client. They become deeply embedded. Circle the globe obviously highlights their vast reach. And they achieve this with a highly trained direct sales and service force of approximately 48,000 associates. Now, these aren't just salespeople. They're on-site experts,
Wow.
in over 170 countries, offering personalized consultation, problem solving. It's not just selling a product. It's about providing actual solutions.
Right, and their revenue model is quite clever, isn't it? It combines specialized chemical products, things like industrial cleaners, water treatment chemicals, with crucial services and proprietary equipment. Think of it like an industrial-scale razor and blade model. They install their unique dispensing equipment, the razor, and then you need their high-margin chemical consumables, the blades.
Exactly.
And this creates a powerful lock-in effect, right? Building predictable, almost annuity-like revenue streams.
Yeah, it really raises an important question. Just how deeply integrated are they? It's not just about a transactional sale. It's really about embedding their entire ecosystem, hardware, software, service, into a customer's daily operations. Makes them incredibly sticky.
Okay, so Ecolab's portfolio is structured into four primary global business segments, each one offering tailored solutions. First, there's global industrial, that's their largest segment. This covers critical areas like water treatment and notably with their 3D TRASAR technology for optimizing water and energy use plus food and beverage sanitation and solutions for the paper industry too.
hmm
Next, we have global institutional and specialty. This addresses the needs of like food service, hospitality, retail. They provide everything from warewashing and laundry to general housekeeping products, even brand protection services through EcoSure. Their K brand, for instance, that's a dominant force in quick service
Yeah,
restaurants.
you see it everywhere.
Then comes global healthcare and life sciences. This is entirely focused on infection prevention in highly regulated environments. So that includes hand hygiene in hospitals under the Ecolab and Aneos brands, and contamination control in pharma manufacturing with specialized products like Purolite for ultra-pure fluid and BioCal for decontamination. And finally, global pest elimination, which, well, pretty much, as the name suggests, provides pest control for commercial customers like restaurants and hotels.
And this diversified portfolio, it really ensures Ecolab touches nearly every part of the modern economy, from a hospital sterile environment right through to your favorite fast food joint. It makes it incredibly resilient. Their scale truly underpins this whole thing. With $15.7 billion in sales in 2024, operations in over 170 countries, that global reach and deep penetration into millions of customer locations is just a formidable competitive advantage. And it gives them dominant leadership in, well, many of these critical sectors.
So the core of their value proposition, it seems, is helping customers achieve better operational and financial results while also meeting those increasingly important sustainability goals. Their tagline, protecting people and the resources vital to life, That really captures this duality, doesn't it?
It does. For customers, choosing Ecolab is, well, it's a strategic decision.
Mm.
It provides tangible economic value by reducing total operating costs, things like water, energy, labor savings, while simultaneously enhancing brand reputation through, improved safety and compliance. It's a clear example of doing more with less, and it aligns perfectly with those growing corporate ESG commitments.
Right. And Ecolab operates in these vast, resilient markets driven by powerful secular trends. I mean, the water and wastewater treatment market, for example, was valued at, what, $346 billion in 2024?
That's right.
Projected to reach $618 billion by 2032. That's a 7.5% compound annual growth rate, CNGR. That's huge.
It is. And the infection control market is also experiencing really robust growth, projected to hit maybe $69–70 billion by 2029, with something like a 6.7% CAGR. These aren't just niche opportunities, they're fundamental markets, driven by things like increasing water scarcity, stricter regulations, obviously heightened hygiene awareness post-COVID, and the growing number of surgical procedures.
So how does the competitive landscape shape up in all this?
Well, in the global industrial segment, it's more of an oligopoly, really.
Hmm.
Competition there is based heavily on technical expertise, value, digital platforms. But in institutional and specialty and pest elimination, it's much more fragmented. You've got lots of smaller, often local players.
Okay, so in those fragmented markets, how does Ecolab stand out?
They truly differentiate themselves by offering superior value. That means premium support, comprehensive training, reliable on-site service, and critically differentiated products that protect a customer's brand reputation. While, publicly traded competitors include names like Clorox, Sherwin-Williams, DuPont, few really offer Ecolab's integrated service depth.
And the regulatory environment plays a huge role here too, right? The industries Ecolab serves are highly regulated. We're talking EPA's Clean Water Act, Safe Drinking Water Act in the U.S., plus countless international equivalents.
Absolutely. This dense regulatory web, it creates persistent, almost non-cyclical demand for Ecolab solutions. Compliance is just non-negotiable for their customers.
Yeah.
It makes Ecolab an essential partner in risk management. And this also creates significant barriers to entry.
How so?
Well, it's incredibly difficult for new companies to get into these markets. You've got high capital investment needed for manufacturing, R&D, complex regulatory hurdles, and just the sheer scale required for distribution networks.
But the real barrier, the one that truly cements their position, it must be the customer's risk aversion, especially in those mission-critical applications.
Exactly. In environments like hospital sterilization or, say, food processing, customers are incredibly risk-averse. They need established providers with a long, proven track record. It makes it nearly impossible for new, unproven companies to gain the necessary trust.
Okay, so when we put all this together, what does it tell us about Ecolab's competitive advantage? Its economic moat. I mean, their success seems to stem from a truly deep and multifaceted economic moat, one that looks like it's actively compounding. Firstly, there's brand strength. Over a century old, the Ecolab name is pretty much synonymous with quality, safety, sustainability. That's a crucial purchasing driver for customers who just can't afford to take risks.
Yeah, and this brand strength is fortified by cost advantages and economies of scale. With over $15 billion in revenue, they have massive purchasing power for raw materials. They can spread significant fixed costs like R&D over a huge sales base. Smaller competitors simply can't match that.
Right. But the real genius of their model seems to lie in their network effects and switching costs. That one Ecolab integrated service model creates exceptionally high switching costs, doesn't it?
Oh, absolutely. Once they've embedded their proprietary hardware, their advanced software like 3D TraceR, and their essential services into a customer's daily operations, well, the disruption and cost of switching to a competitor are just prohibitive.
So it's not just about making a sale.
Not at all. It's about becoming an irreplaceable part of their client's infrastructure.
And the final piece of this compounding moat.
That would be their unique assets and capabilities. Specifically, that immense 25,000-person direct sales and service force we mentioned. These are highly trained experts providing on-site consultation, diagnosing problems, implementing solutions, offering real-time data. It's a relationship-based model that competitors just cannot replicate at scale, and it constantly builds on itself with every new customer, every problem solved.
Let's shift our focus now. Let's talk about Chapter 2. Management evaluation. The company is led by Chairman and CEO Christoph Beck. He stepped into the CEO role in 2021, became chairman in 2022. He's been with Ecolab since 2007, holding senior roles across all major segments, which suggests pretty deep institutional knowledge.
Yeah, a key highlight of his track record includes successfully leading the integration of Nalco after that transformative $8.1 billion acquisition back in 2011. That acquisition fundamentally shifted Ecolab's focus towards water management, and it was a monumental task, really. His leadership during the challenging COVID-19 pandemic also demonstrated remarkable operational resilience.
And it's worth noting their stellar reputation for ethical conduct. I mean, 19 consecutive years as one of the world's most ethical companies, that speaks volumes about the culture, doesn't it?
It really does. In terms of capital allocation, Ecolab takes a balanced approach. They consistently invest in organic growth and strategic acquisitions. They've acquired 55 companies over time, Nalco being the most significant, obviously. More recently, they announced the acquisition of Ovivo's Electronics ultra-pure water business. That signals a strategic move into high-growth, tech-driven markets like semiconductor manufacturing.
Right. And beyond acquisitions, they also consistently reinvest in R&D and sustainability initiatives. For example, their investment in the Water Equity Impact Fund shows a kind of forward-looking approach.
And here's a core indicator of their financial discipline. Ecolab is a dividend aristocrat. They've paid a dividend for 88 consecutive years and increased it for 40 consecutive years. That's impressive.
Wow.
Their current payout ratio is a healthy 33.1, 33.4%, which is very sustainable.
And they also regularly buy back stock, don't they? Both to offset dilution from employee compensation and opportunistically reduce share count. Shows a real long-term commitment to returning capital to shareholders.
Exactly. Now, return on invested capital, ROIC, that's crucial for assessing management effectiveness. Ecolab's ROIC has shown a strong improving trend. It reached 13.2% for the 12 months ending Q2 2025. That's a significant jump from 9.3% back in 2022.
And crucially, their ROIC has consistently exceeded their weighted average cost of capital, their WACC, which is 9.41% over most of the last 5 years. That indicates they are regularly creating real economic value, right?
Precisely. After a slight dip in 2022, their ROIC has rebounded strongly. It's now creating a significant spread over their cost of capital, demonstrating highly effective capital efficiency.
Okay, let's move on then to Chapter 3, Financial Analysis. As of August 23rd, 2025, Ecolab boasts a market cap of $80.25 billion, a major S&P 500 constituent. Looking at revenue trends, after that temporary dip in 2020 because of the pandemic, revenue rebounded sharply, grew 8% in 21, 11.4% in 22, 8% in 23, and 2.75% in 2024, reaching $15.74 billion.
That resilience really highlights their pricing power and the essential nature of their services.
And profitability.
Definitely on an upward trend. Their operating margin hit 17.6% in Q2 2025, up from 15.0% in Q1, and their net profit margin reached 13.59% for the trailing 12 months TTM ending June 30, 2025. That's a significant improvement from the 8-9% range seen in 2022-2023.
Absolutely.
Ecolab's FCF has been strong and growing, from $1.08 billion in 2022 up to $1.83 billion in 2024. This provides ample financial flexibility for growth, dividends, acquisitions. Yeah, and their diluted earnings per share, ETS, shows consistent growth over the long term. For example, rising from $5.33 in 2019 to $7.37 in 2024, and hitting $7.48 for the TTM ending Q2 2025. The only anomalous loss was in 2020 due to the pandemic, which just highlights their strong operating leverage in normal conditions.
And management has also been proactively de-risking the balance sheet, it seems. The debt-to-equity ratio improved from 123.7% down to 80.96% by June 2025. That significantly reduces financial risk.
It does, and their debt is also well covered by operating cash flow, about 32.2%. Plus, a healthy current ratio of 1.32 to 1.44 as of June 2025 indicates strong short-term liquidity. They've got $7.1 billion in short-term assets against $4.9 billion in liabilities. They're clearly in a strong financial position.
And that dividend stability we mentioned earlier, it's further reinforced by a 3-year compound annual growth rate of 7.83%. That consistent growth signals deep confidence in their long-term prospects.
Okay, now for valuation. The current price to earnings, or PE ratio, is approximately 37.9x on a TTM basis. This is at the higher end of its 10-year average of 36.29x, but it's below its 5-year average of 41.99x, which, remember, was inflated by that 2020 dip. The market consistently awards Ecolab a premium. Why? Because of its proven quality and that durable moat.
It does trade at a significant premium to more traditional chemical competitors like DuPont, but it's quite comparable to other high-quality wide-moat industrials. Sherwin-Williams, for instance, trades at a PE of roughly 36.4x.
Right. So for an intrinsic valuation, we use a discounted cash flow analysis, a DCF. This values a company based on the present value of its future cash flows. It involves, forecasting future free cash flow, estimating a terminal value beyond the forecast period, and then discounting these back to today using a rate like the WACC.
And based on reasonable assumptions, what does an educational DCF model suggest?
Our model for Ecolab estimates an intrinsic value range of approximately $245 to $290 per share.
Okay. And the key assumptions driving that?
The model assumes a 5-year revenue growth projection of 4.86%, which lines up pretty well with analyst consensus. We use their WACC as our discount rate at 9.41% and a fairly conservative terminal growth rate of 2.5%. That generally represents long-term nominal global GDP growth.
Okay, let's transition then. Let's look at Chapter 4, Market Sentiment. What does the broader market think of Ecolab? While Wall Street analysts seem overwhelmingly positive, a strong buy consensus, an ABR of 1.98. The average 12-month price target is between $281.90 and $291.13. That's remarkably close to the current trading price of $283.73.
Yeah, very close. And recent news has been consistently positive too, particularly that strategic acquisition of Ovivo's electronics division. That positions them for significant growth in the semiconductor industry, which the market likes. Strong quarterly results, consistent double-digit EPS growth, it's all reinforced their operational resilience in investors' minds.
What about bearish conviction? Anyone betting against them?
Seems not much. Short interest is exceptionally low, actually, about 0.88, 0.89% of the float. That is significantly below its peer group average of maybe 4.5, 4.7%. Indicates a profound lack of bearish sentiment.
And the price action?
Looking strong. The stock is trading comfortably above its 50-day moving average of $269. That indicates strong, positive, short to medium-term momentum.
And it's also significantly above its 200-day moving average of $254. So that signals a robust, well-established long-term uptrend. The market clearly likes this company. Now, on to Chapter 5, ownership structure. Who actually owns Ecolab?
Well, Ecolab stock is heavily held by large institutional investors. Think Vanguard, BlackRock, State Street. This reflects its status as a core holding in many large-cap index funds, which points to a stable, long-term investor base.
That's interesting. What about that particular endorsement from the Bill and Melinda Gates Foundation Trust? What does that signal to you about Ecolab's perceived quality?
It's a strong qualitative signal, definitely. The Gates Foundation Trust, they're known for their long-term investment horizon, their rigorous focus on companies with durable, competitive advantages, and positive societal impact. So their presence really stands out. It suggests sophisticated investors see lasting value and impact here.
And how about insider activity? Are the people running the company buying or selling their own stock?
Well, insider trading over the last 12 months shows more sales than purchases. About 2.1 million shares sold versus only 41,262 purchased. However, you have to remember, many of these sales are typically related to stock options for tax planning, diversification purposes. It's not usually a bearish signal about the company's future prospects.
But interestingly, there have been more open market buy transactions than sell transactions by insiders. A recent open market purchase by director David McLennan, for example. That seems like a positive sign, doesn't it?
It does. It indicates genuine confidence in the company's valuation and future prospects from those closest to the business. So this high concentration of institutional ownership, coupled with, thoughtful insider activity, it suggests a stable, long-term oriented shareholder base. But it also means the company is under constant scrutiny from highly sophisticated financial analysts.
Of course, even the strongest fortress can have vulnerabilities. Let's shift our focus now to Chapter 6, risk assessment. We'll start with a quick SWOT analysis. For strengths, we've got dominant market leadership, strong pricing power, that vast 25,000-person direct sales and service network, a highly diversified portfolio across industries, and robust R&D with, over 6,000 active patents.
That's right. On the weaknesses side, we'd identify exposure to economic cycles in certain segments, like hospitality and food service. Also, vulnerability to raw material costs, and a complex global supply chain that's susceptible to geopolitical disruptions.
Looking ahead, opportunities seem plentiful. The increasing global focus on water scarcity is a massive driver for their water management solutions. Expansion into high-growth sectors like life sciences and microelectronics, and leveraging digital transformation through IoT and data analytics for new revenue streams. Lots of potential there.
Definitely. But then there are threats. We see intense competition in certain areas, the risk of a broad economic downturn impacting demand, potential regulatory changes increasing compliance costs for their customers, and potential customer resistance to continued price increases, especially if raw material costs stay elevated.
Speaking of costs, how do broader macroeconomic factors like inflation impact a company like Ecolab?
Well, inflation directly impacts their costs for chemical raw materials, energy, logistics. Now, while Ecolab has shown a strong ability to pass on these costs through pricing power, sustained high inflation could lead to margin pressure or perhaps reduce sales if customers start resisting further hikes. Rising interest rates also increase borrowing costs, they limit strategic flexibility for acquisitions, and they increase their WACC, which directly impacts that intrinsic valuation we talked about. Plus, higher rates can just dampen overall economic activity, affecting demand.
Okay, here's a particularly interesting and specific geopolitical threat you mentioned: the announced implementation of new U.S. tariffs in 2025. A 10% baseline tariff on all countries is set to take effect in April 2025. That sounds significant.
It is. For a company with Ecolab's complex global supply chain, these tariffs represent a direct and quite significant threat to its cost structure. This isn't just theoretical. This could hit their bottom line directly. How significant is this as a real-world test for their pricing power and the mission-critical nature of their services? Well, it will be a true stress test of their economic moat strength. We'll have to see how they navigate it.
Finally, we arrive at Chapter 7, Conclusion. Let's try and synthesize everything we discussed here.
Okay. The investment thesis for Ecolab, it's really built on a truly exceptional, high-quality enterprise. It possesses a wide and durable economic moat, fortified by immense scale, those high switching costs from its deeply integrated ecosystem, and that unparalleled direct sales and service network.
Right. And it operates in markets driven by enduring, non-discretionary secular trends like water conservation and hygiene. These aren't going away anytime soon. Management has a long track record of disciplined capital allocation. 40 years of dividend increases, consistently rising ROIC that exceeds its cost of capital. It makes it a quintessential long-term compounding machine.
Absolutely. But despite these undeniable strengths, there are valid concerns. The primary risk really is the stock's valuation, trading at a PE ratio of approximately 38x. Well, the market has already priced in significant future growth. That leaves a little margin of safety for new investors at this price.
And the business isn't entirely immune to macroeconomic and geopolitical risks either, is it? Sustained inflation could erode some of their pricing power, a broad economic downturn could impact demand in certain segments, and those impending 2025 U.S. tariffs pose a direct near-term threat to its cost structure.
Correct. So our comprehensive DCF analysis, using, remember, conservative assumptions like a 4.86% revenue CAGR and 9.41% WACC, estimates an intrinsic value range of $245 to $290 per share for Ecolab Inc.
So putting it all together, what's the takeaway for you, our listener? As of August 22nd, 2025, Ecolab's share price of $283.73 falls, well, right within the upper end of our estimated intrinsic value range.
Yeah. This suggests that while Ecolab is indeed a high-quality enterprise with formidable competitive advantages and a bright long-term future, its stock appears to be trading at a price that fully reflects, or is perhaps slightly ahead of, its current fair value. So for the long-term value investor, this indicates a wonderful company, no doubt, but trading at a price that may not offer a significant margin of safety right at this specific moment in time.
What stands out to you after this deep dive into Ecolab? It's fascinating, I think, how they're doing more with less sustainability approach, coupled with their embedded service model, transforms complex regulations and resource scarcity into an opportunity for growth and strategic partnership. It makes you wonder how many other critical industries will increasingly rely on these kinds of deeply integrated expert partners to help them navigate an ever more complex world, finding efficiencies and fulfilling ethical commitments at the same time. Something to think about. If you want more deep dives like this one, please like and subscribe to the Stock Analytic and AI YouTube channel. For just $4.99 a month, members get priority deep dives on tickers. Over the next few months, we're covering all of the S&P 500 stocks, and members get exclusive priority access. If you want a one-off deep dive on a specific stock, just drop us a super thanks. And a quick disclaimer, this analysis was generated by an AI system for educational purposes only and should not be considered financial advice. Please conduct your own research or consult with a qualified financial advisor before making any investment decisions.